Hello, everybody, and a warm good evening to everybody out there in Australia. Uh, First of all, I would like to give the picture of the Indian economy, the way the things are moving in India. I'm very sure everybody in Australia who are physically in Australia, but I'm very sure that their hearts are definitely in India and they keep a tab of whatever is happening in India for sure. So I would like to give some perspective, little analysis of what is happening as of now in the Indian economy. And when we talk about the state of the Indian economy, we need to look at the winds of change which are blowing not just in India but across the entire world. The first and foremost thing which is important for anybody for that matter is the US tariffs, which has been the news every day, and India is no exception to it. In fact, India has been inflicted with the highest level of tariff, which is at the rate of 50%. And the only other country in the world which is facing this kind or this level of tariff is Brazil. But India is fortunate that there are some goods and services which are out of this tariff regime. First is the Indian pharmaceutical industry, which is very important in terms of the size and penetration which it has in the US markets. The Indian IT industry, the IT services, as they are services, they are out of the ambit of it being classified as any kinds of goods. So they are out of tariffs. And the third and most important, and which is a very upcoming business which is developing in India, which is catering to the US, is manufacturing of electronic goods. India manufactures a lot of Apple phones and Samsung phones, which are shipped to the US. But unfortunately, there are a few sectors, especially prominently three of them, which have been quite impacted on account of the US tariffs. The first being garments and leather goods, gems and jewelry, and engineering goods. All these three sectors are labor-intensive sectors. So this can impact to a good extent that very sector, the peripheral sectors, and the chain effect on the economy. Well, India is not an export-driven economy, but these sectors can definitely impact the level of growth in the Indian economy. And according to certain estimates, the Indian GDP growth may be down by 0.5% or 1%, according to different estimates. But India is preparing itself, and other countries which have been inflicted upon these kinds of tariffs by the US are also preparing. BRICS, Brazil, Russia, India, China, and South Africa. This entire set of big economies, they are slowly but steadily realigning themselves. And this week, we could see that the countries which have been impacted the most on account of the US tariffs, which is China, India, Brazil, and Russia, were all together on a united front in China. That whenever there is a crisis, when India has been challenged, India has always been quite resilient. And so is the way the Indian economy and the Indian government is responding as of now. If we look at the macros in the Indian economy as of now, the GDP growth rate for the month of April to June has been at the very, very promising rate of 7.8%. It is much beyond the best of the estimates which different observers on India had. It was really a pleasant surprise. Insofar as the monetary policy is concerned, the central bank of the country, the Reserve Bank of India, has cut the interest rates by 100 basis point 1% in last 1 year. And today the repo rate in India is 5.5%. Inflation in India for the month of July, CPI, Consumer Price Index inflation in India was just 1.55%, which is below the comfort zone, even the band of the comfort zone of the Reserve Bank of India, which is in between 2% to 5%. So it was much below the expectations or the way the Reserve Bank of India, the central bank, is looking at. When it comes to the fiscal deficit, the way the finances of the country and the central government are managed, India's fiscal deficit for the financial year 25-26, according to the budgeted estimates, is 4.4% of India's GDP. And if you compare this with the fiscal deficit of the US is expected to have a fiscal deficit of 6.1% of the GDP. So in terms of financial discipline, India is definitely, the things are quite in place. The government, in all the measures which it could take to respond to the dynamics which are emerging in the economy, is quite proactive. The consumer demand in last 1.5 years was a little slow, but the government is quite cognizant of it, and it has ushered in reforms on indirect taxes, which is the GST in India, in a very substantial way. In the budget, in the union budget, they had given reliefs in the direct taxes, and both these things together, the relief in direct and indirect taxes, would lead to a lot of consumption boost. And this is very important to, as I said, to address the slowing consumer demand as well. Whatever is the kind of impact which the US tariffs are going to have on India, this is a way to respond to that sluggishness which might be caused on account of these tariffs. Industrial production in India has been a challenge. In a country in which the GDP is growing at 7.8%, industry is just growing at 3.5%. But there also the government is proactive. There is a lot to spend on infrastructure, ease of doing business, and last but not the least, and very important in the recent few months, that the Reserve Bank of India has been, according to some observers, deliberately allowing the weakening of the Indian rupee for the reason that exporters are benefited and imports in India become a little expensive, so that manufacturing in India can revive. The global headwinds on account of the tariffs, as I initially started with, are real. But India, the way it is responding, it is taking into account and it is putting on forefront its national interest, considering it as supreme. We have seen that there are several trading blocs of the US, maybe Europe, Japan, who have rather agreed to certain terms of the US, even as the observers feel is not in the national interest. But India has remained strong and firm, and that is what is quite important for all of us, whether they are staying in India or outside of India. With these words, I hand over for the balance interesting part of the presentation, and I thank Sanjay for giving such a nice introduction for our company and for both the speakers. Thank you so much. Thank you.
You're welcome. Thank you, Daxesh Bhai. I'll hand it over to Rajit to take us through the rest of the presentation. Please, Rajit, over to you.
A very good evening to all the participants who have joined from Australia on this Saturday evening. And special thanks to our dear friend Sanjay Bhai for introducing us and setting the stage for the further presentation. Going forward with today's topic, which is two important junctures of every person's life cycle, which is inheritance and retirement planning. Starting with the first aspect, which is inheritance of Indian assets for persons of Indian origin who are located in Australia. The question commonly that we receive as far as the inheritance is concerned is that what happens to the Indian assets of any Australian citizen who may be OCI card holder on his death? And will the succession laws of the Indian assets be governed by the laws of India because the assets are located in India, or as per the laws of Australia because the person who owns the assets is an Australian citizen? In this case, as far as the Indian assets are concerned, whether it's movable, meaning financial assets, or immovable, meaning real estate, the succession would happen as per the laws of succession in India. The succession on death of any person would happen by two ways. One is when there is a will, a valid will as per the Indian succession law, which is called as a testamentary succession. Then it would happen as per whatever is mentioned in the will. And when there's no will, which is called as intestate succession in technical terminology, it would happen as per the applicable personal succession law, which is Hindu Succession Act in most of our cases. What are the essentials of a valid will? It's quite simple. The testator, who is the person who is making the will, needs to be of a sound mind and should be having the age of at least 18 years. And it should be made under, it should be voluntary, it should be in writing, and it should be signed by two persons who are ready to act as witnesses to the will. There is no fixed legal format that has been mentioned in the law, but these are the basic essentials which needs to be fulfilled. And ideally, any will should be notarized, and there should be affidavits by two of the witnesses who claim that the will was made in a voluntary manner and in a sound state of mind by the person who is making the will. This is a common question which we receive from most of the people that we interact, that whether the person needs to be in India to make a will or can make a will sitting in Australia. The answer to this is that it can very well be prepared sitting in Australia because, as I mentioned, the only requirement is all the essentials of a valid will, which is that it should be signed by the person who is making the will, the testator, and two witnesses should sign it additionally in front of a notary public who could be in Australia, and declarations, which is called affidavits in the legal terminology, should affirm this and should claim that the will was made in sound state of mind, as I mentioned. Now, what would happen when there's no will? As I mentioned, it would be governed by the succession as per the Hindu succession law. Whenever there is a Hindu male who dies without a will, which is intestate, then this is the order in which the succession of those assets would be carried out, which is, in the first place, and in most of the cases, it would go to the class 1 heirs in equal proportion. The class 1 heirs are the wife of the male, the children, the mother, and the grandchildren if the son is no longer alive. So all the four parties will have an equal share in the estate or the assets, total assets of the Hindu male who dies without making a will. In case if none of these four parties are alive, then all these other relatives of the Hindu male get the right to the assets. And this is not in equal proportion, but the first person in order of the succession, in order of the manner mentioned in the law, get entitlement to the entire property. What happens when a Hindu female dies without making a will, which is intestate? In the first priority, all the children and the husband get an equal share of the property. And thereafter, if none of these parties are alive, then the other relatives get the entitlement to the property. I'll not go into each of them. Now, how would this actually work out? We understood as to who can get an entitlement or a right in case of each of the eventualities when there is a will and when there is no will. But practically, what are the steps that someone will have to encounter to ensure that the beneficiaries who are entitled to the estate get the right to use it or to sell it? When there's a will, a person dies with a testamentary succession, then the executor, whosoever has been mentioned in the will, has to make an application to the jurisdictional court wherever the deceased person was situated for something called as a probate. A probate is a court order of the court which authenticates any will and makes it as a valid will which should be accepted by all the parties. Probate is mandatory in certain cities of India, but is not mandatory across India. It also depends on where the assets are located. Meaning, if they are located in certain cities where the probate is mandatory, then it needs to be carried out. But in certain cities, there is no requirement of probate. Then a will can also do the succession requirement in terms of transferring the ownership title. And the final step is that after obtaining a probate, the beneficiaries can get entitlement or the title of ownership basis the order of the court, which is the probate. In case where there is no will and a person dies intestate, then as far as the immovable assets are concerned, which is the real estate, the way in which it would work is that in the first place, there needs to be a family tree which needs to be obtained, a family tree certificate by the government authority, the local government authority, wherever the deceased person was located. Thereafter, basis this certificate, an application needs to be made to the respective jurisdictional court to obtain a succession certificate or a heirship certificate in India. And basis this heirship certificate, which mentions and outlines all the assets of the deceased person, the title is transferred in the revenue records of the place where the property is situated. And basis this entire chain of documents, which is the succession certificate, heirship certificate, and the revenue records, a person can get the ownership title for the immovable asset, the real estate property, and can sell it further, lease it out further, or use it for personal purposes. As far as the movable assets are concerned, which is the financial assets predominantly, the bank deposits, investments into mutual funds, stocks, any other form of financial asset, the way it would work is that the death certificate of the person, if the person has died outside of India, in Australia or any other part of the world, needs to be apostilled by the Indian embassy. And this apostille document needs to be submitted to the respective financial institution, which is most likely the asset management companies. And basis this, the nominee, whosoever has been mentioned in the particular investment, gets the custody of the investments, whatever is there at that particular time. Whenever we make any kind of financial asset, then a nomination is mandatory and the nominee gets the custody of the entire property. When I say that the nominee gets the custody of the entire property, many people understand that nominees get the ownership title of the property as well. And we often come across this question that then in that case, is nomination enough? I've already made the persons that I want, I already made my spouse, for example, as the nominee of my investments. Then will that suffice the requirement? We must understand here that nomination merely gives custody, meaning entitlement to use those assets or to have a custody of those assets, but it does not give the ownership title of the particular financial asset. To carry forward the example that I just narrated, if a person has made his spouse as the nominee and has got 2 children, then and has died without making a will, then as per the Hindu Succession Act, as I mentioned, that the wife as well as both the children, all 3 of them will have an equal entitlement, an equal share in the property of the person who has died. In that case, the wife may get custody of the investments and may step into the shoes of the person who has died, but the children can contest the wife and can claim for their own share in the property. So we must understand that the ownership title happens as per the laws of succession, maybe as per the will, if the will is made, and if there is no will, then all the beneficiaries who are entitled to those assets as per the respective law, which is the Hindu Succession Act. Moving with the second part of the presentation, which is retirement planning, we come across a lot of people who have got dreams to spend the golden phase of their life, which is retirement in India. But it is very important to back it by adequate financial planning. And why do we choose India as the ideal retirement planning destination? The answer to this is quite simple. We must build a retirement kitty in the place where we see the maximum amount of growth of the economy, and subsequently growth of our corpus. As of now, India is the fastest growing economy in the top 20 economies of the world, undoubtedly, and is surpassing all major developing as well as developed economies by a very significant margin because of all the factors that we discussed in the earlier part of the presentation. Stock market, which we know is the barometer of the economy. If we look at the stock market performance in the last 3 years of the Indian markets, then they have been one of the best performing markets, especially the small cap as well as the mid cap, which are not the most known popular large companies, but companies much beyond that, beyond the top 100 companies in India, which shows that the growth lies deep down in the actual the entire the corporate all different kinds of companies in India. Despite of the global headwinds that we have been witnessing in the last few months, still, if we look at the last 3-year performance, then the Indian markets, as I mentioned, have surpassed all other major markets, also the developed markets, as well as the Australian markets by a very significant margin. Now, what are the retirement planning strategies that a person living in Australia can look forward as far as building a retirement corpus in India is concerned? This retirement corpus can be built by both the ways, which is through fixed income as well as equity. As far as the fixed income basket is concerned, there are guaranteed income plans which can be considered. And as far as the equity basket is concerned, then naturally the Indian markets offer a vast range of opportunities in mutual funds, PMSs. We also have the GIFT City, and a corpus can also build in the US market. Let us go into each of them one by one. First is the fixed income basket, which is through a guaranteed income plan. There are a lot of guaranteed income plans which are available these days in India, which offer a fixed return for very long tenures, as long as 30 to 40 years. The investment needs to be done in installments, which could range from 5 years to 10 years, depending upon the requirements and the stage in which the individual is in his or her financial life. And the beauty of this kind of an investment is that the income can start from the very next month and can go on as long as 30 to 40 years. And this income is guaranteed, come what may, irrespective of whatever are the changes that might happen in the economy, subsequently the stock market, or even the interest rates. As we know that the interest rates in India are declining on a continuous basis, and if we park a NRI deposit today with any bank in India, we are really not sure whether those kinds of rates will be available to us when we renew those deposits after 3 to 5 years. But the idea behind this kind of an investment plan is that this income can be guaranteed for very long tenures, and this is completely tax-free in India as long as the investment is restricted to 5 lakhs of rupees per individual per financial year. And there is also a death benefit, which is a life cover, which is associated in these kinds of investments, which is to the extent of 10 times of the investment that is being made over and above the guaranteed income that keeps flowing. Mutual funds, as we know, are another popular means of investing as far as the equity market basket is concerned. And so far, it's the most popular means of participating in the equity market through a professional mode, and is also a very convenient means of investing. The ideal mutual fund portfolio should be made basis all these parameters that we have mentioned, which is the financial profile of the investor, meaning the kind of incomes, assets, the liabilities that the particular individual has, the kind of risk in terms of the volatility, the ups and downs in terms of the value of the investment that the investor is willing to take. And after all, what are the goals for which the investment is being made? What is the time horizon that we have in mind? Systematic investment plan is something which is very popular these days in India, and a widely accepted means of investment. I mean, to the extent of 27,000 crore rupees a month, SIP flows are going on. So the entire country has now accepted this to be a systematic means of participating in the capital markets in an organized manner. The mutual fund basket comprises of several categories, which we have mentioned in the slide, which is multi-cap, mid-cap, small-cap, so on and so forth. But an ideal portfolio should have an appropriate bifurcation and distribution across all these categories, because each one has an important role to play in the growth of the entire corpus out of the portfolio. And there are several other parameters which also needs to be considered while building a mutual fund portfolio, which is the concentration of different mutual funds, which should neither be lopsided or tilted towards only a few ones, and should also not be too diversified across a lot of funds. Quartile performance and benchmark comparison are also very important parameters which need to be considered. Just to give an illustration, basic illustration of the manner in which we construct a mutual fund portfolio and select mutual fund schemes. These are all few of the sample parameters that our research team uses to pick and choose mutual funds. These are several factors, which is portfolio turnover ratio, meaning the number of times the portfolio is churned, which is quartile performance, as I mentioned, dividing the entire basket of mutual funds into 4 equal parts in the ranking of the performance, and then ensuring that our mutual fund is in the first 2 quartiles out of the 4, which is in the top 50% of the entire basket. Then comparing it with the benchmark. Just as we know of Sensex, Nifty, which are the most common indices, there are several different benchmarks for each categories. The way we have got a small cap category illustration in this slide, it has got a small cap benchmark, which is BSE 250 small cap. We should ensure that our fund is outperforming or delivering more return than the relevant benchmark across all time frames. These are just few of the illustrative examples that I've used, but there are several such different parameters that we use called as key performance indicators to select and construct a mutual fund portfolio. And it's also important to review this portfolio on an ongoing basis so that our portfolio remains agile and we keep taking opportunities and benefits of the changing trends that are surrounding the economy and the markets right now. Another means of investing into the equity market is by portfolio management services. The concept of a PMS is same as that of a mutual fund. There is a professional fund manager, and we rely on the research and the entire depth and in the entire investment selection of that fund manager, asset management company and their team. But the way it differs is that there is a separate demat account or a brokerage account that is opened for that particular investor, and the equity shares are owned by that investor who is opening a PMS. So similar to a mutual fund, the choice of the portfolio strategy can be done by the investor, which is small cap, multi-cap, mid-cap, and that too depending upon the financial profile. But which stocks to buy at what valuation and when to sell is the prerogative of the asset management company, and that task is basically outsourced. How is a PMS different from mutual fund? That's a very common question that we always receive. It is apart from the structure of investment, which is a separate demat account that is opened and in which the shares are bought and sold. There are 3 other distinctions, which is number 1, that the portfolio is much more concentrated than a mutual fund, meaning the number of stocks that are held by a PMS are much lesser in that of a mutual fund. A PMS typically owns 20 to 40 stocks in its portfolio, while a mutual fund owns maybe 50 to 100 stocks and more than that. So since the portfolio is much more concentrated, the kind of return expectation that we can have across a longer period could be naturally on the higher side mathematically. The second point of distinction is that the regulatory restrictions that we have in case of a PMS are much lesser for the fund manager to take different bets than in case of a mutual fund, because in case of a mutual fund there are a lot of regulatory caps, such as a stock specific cap, meaning a mutual fund cannot own more than 10% of its overall corpus that it manages in a particular stock. It cannot own beyond a particular percentage in a particular sector. While in case of a PMS, there is no such restriction. So the fund manager has got a free hand to pick and choose the kind of stocks that he feels is appropriate. The third point of distinction is that since mutual fund is a common pool in which all the investors are investing, then the inflows and outflows of all the investors impacts that entire pool. When in case of a PMS, since it's an earmarked separate demat account, the inflows and outflows of other investors does not impact this entire pool of investment. And the minimum ticket size in case of a PMS is 50 lakhs of rupees. This is the data matrix that we use to select a PMS and the strategy within a PMS. Let's say if we start with a PMS of 50 lakhs of rupees, then there can be two strategies of 25 lakhs of each that we can adopt out of it. And we use when we evaluate the PMS on several parameters that I have mentioned, not just the past returns, but also the bifurcation across large, mid, small categories, the fund managers who are involved, the amounts that are managed, so on and so forth. Moving beyond the shores of India comes global investing, and US markets are the mother markets of the world, and it is very important to diversify beyond a particular market. So since many of you would already be having investments in not only real estate but even in financial assets in Australia, but are considering diversifying it into another economy, which is India, it is also important to diversify beyond the emerging markets, which is the developed markets, which is US, which is the largest stock market in the entire world in the size of the market capitalization. This is all possible through a platform that we have developed in association with a reputed broking partner in US, which is Tribal, in which there is a fixed fee that is charged on the entire portfolio value. There is no separate charge, and the funds can be remitted directly from Australia to US and back. There is no tax implication in India if the funds are originating from Australia and are received back directly in Australia. And naturally, so if there are no implications, there's no tax implication in India as well. This is the snapshot of that platform which we have curated, which gives all the details that someone might want to know as far as the US equity investment is concerned. Few of the sample portfolios that we have curated for the investors. These is different themes, which is EV, the Magnificent Seven, which we all know of, the mega tech companies, and few other sectoral kind of portfolios that we have curated. Superannuation is something which all of you present today would be aware of, and is a major means of retirement, building a retirement corpus in India. Retirement corpus in Australia for all the Indian origin persons. Now, this superannuation funds can be self-managed, which also many of you are aware of. And so the corpus can be built by both the ways, which is by self-managing the superannuation corpus and by the non-super fund, which is the personal funds of any individual. We often receive this question that how can we self-manage it? We are not professionally qualified to advise on the Australian laws as far as the SMSF is concerned, but this is the manner in which so many of our clients across Australia have set up their super funds and have been building and multiplying, I would say, their corpus, super fund corpus in the last several years that we know of. In which what happens is that firstly, once there is a super fund, accountant needs to self-manage it and opt for that option. Thereafter, there's a trust deed that needs to be formed. which should allow all kinds of permissible investments. And then a ABN and a TFN needs to be obtained. This needs to be submitted to the bank to obtain a CMA, cash management account, in which all the financial transactions of the super fund will be routed, and the corpus of the CMA can be then transferred to the Indian account, which is the NRE account, which is the repatriable account, and thereafter this NRE account can be utilized to enter into any kind of investments in India. And there needs to be an annual audit as well as tax return that needs to be filed by the accountant. Few of the points that we must keep in mind while executing this kind of a process is that the holding pattern of the investments in India, as well as the bank account, needs to replicate that of the super fund trust in Australia. Let's say if the wife is the first holder and the husband is the second holder, then the same holding pattern needs to be replicated ideally in the bank account in which the super funds are rooted, and also in the investments that are made subsequently in India from that bank account, so that a clear-cut trail is maintained. And ideally, the super fund transaction should not be mixed with the personal non-super fund transactions of that individual. Meaning there can be a separate NRE account that is started in India with any bank, maybe a different bank, where the idea is to have these super fund transactions and invest it further on, so that all the transactions that are transpired through that bank account are something that is meant for super fund, and a clear-cut trail can be passed over to the accountant as well as the auditor whenever the compliance is going on. Certain practical insights that I wanted to share. This is whatever we have come across all these years on retirement planning. One of the major concerns that we often hear from so many of the investors who really want to build a retirement corpus in India is the depreciation of the Indian currency. We all know that the Indian currency has been continuously depreciating all these years, not just against AUD, but against all other major developed market currency, which is USD, GBP, so on and so forth. Now, if we are to analyze the actual rate of depreciation in the last decade, then the annualized depreciation, which is the compounded year-on-year depreciation of the Indian currency from 47 rupees a dollar to 56, 57 rupees a dollar, is at the rate of less than 2%. So a lot of us are under this kind of impression that the depreciation is much beyond the kind of numbers that we often hear from people who are expecting this kind of a fear, is way beyond this. So the entire loss that might happen on account of this currency fluctuation is at the most 2% basis the past data. If we are to analyze the future prediction of the kind of depreciation that we will anticipate, then we must understand that this currency depreciation happens on account of two factors which I mentioned in the slide, which is number one, the demand and supply of Indian currency vis-a-vis the Australian currency, which is the inflows into India and outflows out of India to Australia, and the difference of the inflation between the two economies. Since India runs a higher inflation than Australia, then this depreciation of currency is something that is likely to happen. Now, going further from here, then the inflows and outflows are beginning to turn in the favor of India in the last few years, with a lot of structured FDI investments, not just from Australia but across the globe, that has started with these Teslas and the Apples of the world setting up their manufacturing facilities in India, and also with the FI investments turning positive in India. And the inflation differential is also something that is by and large similar or has started reducing, which is why the depreciation going further may not be at this rate, it might also reduce. Real estate is another important avenue which a lot of people based in Australia are looking forward to invest in India to build their retirement corpus naturally. And this is another question that we receive on account of that how is real estate a tool for retirement planning? we must understand that howsoever lucrative we might find real estate market in India, there are several challenges that are now coming up as far as real estate investing in India is concerned. This is what we see for so many of our clients. Number one, liquidity of any real estate property at the desired price within the desired time is a major challenge. Managing the real estate property, which is safekeeping in case of a land and maintaining in case of a constructed property, is a major hassle. The entire task of investing, disinvesting, and repatriating those funds is all possible, but is quite tedious and takes a lot of time and efforts. The next generation of most or all of, I would say, everyone that I know of in Australia is not intending to relocate India, not even forget about relocating, they are not even keen to visit India on a frequent basis. Then in that case, it might not be a good idea to hand over a estate of real estate properties to the next generation to manage and to sell it off at a later date. As long as someone is looking to self-use it in a very active manner, then it might be a good idea to invest in real estate. Otherwise, financial assets are a much better means to build a retirement corpus than the real estate. Gift City is something that has recently come up in India, and a very interesting development that we have witnessed in the last few years. I'm sure all of you would have come across Gift City in some or the other manner, and there's a lot of hearsay about it. Now, this Gift City is a global financial center that is coming up, something as an international financial services center, the first of its kind in India, and the idea of the government is to make it similar to any other global center, financial center, which is Singapore, Hong Kong, Dubai, DIFC, so on and so forth. So there are a lot of tax benefits and a lot of regulatory benefits that the government has announced for this area, which is Gift City. Geographically, this is very much a part of India between the cities of Ahmedabad and Gandhinagar. But this entire Cowed region, which is mentioned in this, which has been highlighted in this slide, is an offshore jurisdiction, meaning it is a special economic zone which is not covered under the Exchange Control Law of India, which is FEMA. And there are a lot of tax benefits which are announced for financial services activities in India. This is how any person living in Australia can take benefit of these announcements which are there by the government. The minimum ticket size for investing in through the Gift City route is 150,000 US dollars. And the way it would work is that if there is any person in Australia, maybe a person of Indian origin like you, or a foreign national does not have any connect with India, or even a trust, which could be a super fund or a business, they can invest into Gift City funds, which is alternative investment fund. This is a technical name of those funds, which would invest into the Indian mutual funds. So the underlying investment as such is very much in the Indian mutual funds. All the mutual funds that we have been investing since not just years, but decades, I would say. But we are routing it through the Gift City, and this is a funnel kind of arrangement to take benefits of the regulation where there's no income tax in India. There's no requirement of filing tax returns naturally if there's no Indian income tax implication. Also, no question of any tax assessments or anything. There's also no requirement of opening any kind of a bank account in India. So the funds can flow directly from Australia to the Gift City fund and back. There's also no requirement of starting any broking account, demat account in India. And the investments are denominated in USD. The onboarding is also very simplified. This is the manner in which it would happen, that the investments would be happening in the Gift City funds, the AIFs, which is the technical name. AIFs would be investing into the Indian mutual funds, and the gains, whenever these investments are sold, are completely tax-free to the fund as well as to the investor, so that the funds can be repatriated back in a seamless manner. So the advantage, which I already discussed, to repeat, there is no tax implication, no requirement of any demat or a bank account, and all denominated in USD. This is a glimpse of the events, very successful events that we organized last September across Australia, where we were fortunate to meet hundreds of persons of Indian origin across all these 4 locations of Australia, which is Brisbane, Canberra, Melbourne, and Sydney, and empower them on topics of Indian financial planning. A final message by our Prime Minister recently at the World Leaders Forum: the kind of reforms which all of us undoubtedly have witnessed and the change that we have seen in the last decade is unprecedented and has ushered the entire Indian growth story to a new dimension, I would say, to attain the dream of being a developed nation, a Viksit Bharat by 2047. A general disclaimer that all the views in the presentation were personal, and we do not intend to opine on any Australian laws, and wherever we have used any data, we have mentioned the source of it. A brief about us before we move forward to the question answer session. We have a legacy of more than 65 years, being a one-stop solution provider with a team of more than 60 persons across all different domains of finance, with active office presence across the western belt of India, in the cities of Ahmedabad, Rajkot, the GIFT City, and the Mumbai, managing more than 1,000 crore rupees of assets, predominantly in the Indian markets, in Indian mutual funds and PMSs, and also in the global markets, which is the US market, to the platform that we have developed, as I mentioned earlier, in serving a base of more than 5,000 clients across 25, 26 plus countries. The services that we provide per se are number one, investments. The entire spectrum of investments, right from the Indian equity markets, which is the mutual funds, PMSs, in private markets of India, which is the unlisted space through AIFs, as well as the US markets through the US stocks, ETFs, and also global stocks that global ETFs that we are able to invest through the US market. GIFT City Solutions, whenever someone wants to invest in India, maybe in a non-individual route through a PT or a PTY Ltd company in Australia, or a super fund trust in its own capacity, not an individual capacity, then it is possible to be a route of GIFT City. And there are several other regulatory advantages which are already discussed. Indian income tax compliances, end-to-end compliances is something that we are into, as well as tax assessments and also advisory and planning relating to it. Indian estate planning for all the assets that are situated in India, as we discussed today in depth, through preparation of wills in India, as well as private trusts wherever there is a need to do so. Indian life insurances, because we are insurance brokers and we work with all life insurance companies in India. International tax compliance is something which is very important, because all the incomes that any Australian tax resident has in India needs to be reported in Australia, because any Australian tax resident needs to report the global incomes. So there's a DTAA, double taxation avoidance agreement, or treaty, wherein whatever taxes that are paid in India, we help to take a credit or a set off while paying the Australian taxes through a consolidated report, which is prepared for Australian tax residents through our service of International Tax Compliance Support Service. Financial regulations advisory, be it repatriating funds out of India, or for any kind of other financial transactions in India. This gives loans or any financial other transactions. We provide thorough advisory. Coordination with the bank wherever there is a need to do so, because banking, as we know, is a tip to enter into any kind of financial activity in India. The advantages for anyone who is working with us is that there's a single point of contact for anything and everything that they can think as far as Indian financial affairs are concerned. In other words, we're like a family office to them for their entire financial activities in India. This is all possible through a single point of contact of a relationship manager from our team, who is backed by all different specialists from financial domains. This brings a lot of convenience to the person who is working with us, and also to us in terms of discharging the holistic financial advisory, and eases the tax compliances as well. So far as our charging mechanism is concerned, and all these ancillary services that I mentioned, be it taxation, estate planning, international compliance, advisory, is all complimentary that we provide from our side as long as the investment portfolio is managed by us. If any one of you happens to visit any of these locations, it will be a pleasure to meet you in person and interact with you further. Thank you so much for sparing your valuable time on this Saturday evening. And we would be more than happy to answer any of your questions that you have. The entire presentation, along with the in the recording of this session in form of a YouTube video link, will be available to you on your WhatsApp, on the number that you could have provided to register for this webinar.
Thank you so much, Rajit. We've got a couple of questions. I might just take the first one is from Nishant. Under PMS, what is expected return? And it's understandable that it's subject to market condition, but what would be good to have some indicative view on expected return on PMS.
Sure, sure. So, if I were to give a number to the expected return, then it is a summation of three different constituents. Number one is the growth rate of the Indian economy, which is around 6.5 to 7% as per IMF and all other projections. Over and above that, there's the Indian inflation, which runs at about 4 to 5%, which brings to 10 to 11% the average rate of growth of all the businesses that we see around us in India. And naturally, when the business and the earnings of these companies are growing at this rate, then the stock market appreciation of all the companies would also be growing at this rate, which is the average of 10 to 11%. And because we are going through a managed route of a portfolio manager, where there's a concentrated portfolio, then another outperformance of at least 4 to 5% is something that we can expect, which brings to about 15 to 17% is the kind of returns that we can expect from a PMS. There's no guarantee because it's equity oriented investments. And if we are to look at the past 5 years, then it has done even better. All of the good performing PMSs that we have suggested have delivered much better than this in the last 5 years. But this is a conservative estimate to look at the future. And this would happen not in a linear pattern, meaning every year it might not happen, but it would happen in the very standard function in which the entire equity market performs, which is ups and downs, but across a period of 4 to 5 years, it should be the minimum horizon when someone is looking at a PMS equity investment in India.
Thank you so much. The second question we have is from Bhavesh Bhai. Is there any special inheritance regulations regarding the immovable property such as ancestral agricultural land?
Okay.
I'll just address that question. So, the way it would happen insofar as the inheritance of agricultural land is concerned, that the moment there is a death of the person who is holding the agricultural land, the legal heirs of the deceased need to get in touch with the local Talati Mantri, if it is in the state of Gujarat, and inform about the happening. So then we need to give the details of the legal heirs of the deceased. On the basis of that, the transfer would be in the names of the legal heirs of the deceased. Now, if there are some heirs who would like to waive their right over this agricultural land, then affidavits in respect of that waiver have to be furnished to the Talati Mantri, and he will take on record all these submissions, and on the basis of that, he will pass the transfer entry for the agricultural land in the revenue records. And that is something which will suffice insofar as transfer of the title in respect of the agricultural land is concerned.
Awesome. Thank you so much. Anything else to add, Rajit?
That is fine. So if there's any other questions, if someone wants to unmute themselves and ask any questions, then they can just click on the raise your hand button or drop a message, and we'd be happy to unmute them and interact with them.
There's one more question that has come. Give City Pathways minimum 150K USD, but is there a minimum maintenance?
So the minimum amount to start as far as Gift City Investments is concerned is 150,000 US dollars. And thereafter, there is no minimum maintenance in the sense, whenever the value crosses $150,000, then depending upon the asset management company, a certain amount can be withdrawn. But so even if it goes below $150,000, then that is fine as per the market fluctuation. But if it is not crossing $150,000, then there's no withdrawal that can be made. The withdrawal can only be made when the valuation crosses $150,000. But till then, there's no withdrawal that can be made. So the minimum maintenance as such is $150,000. Only if the valuation goes below that due to market fluctuation, it's fine. But that's something that needs to be continued thereafter.
So long as the initial investment is 150 USD, there is no other requirement for maintenance. Closeout has to be full as exit.
Yes, so as I mentioned, each of the fund has got a minimum amount for addition and withdrawal that they have designed. For example, there are few funds who have got that kind of a mandate that the exit has to be fully, completely. But there are few other funds who allow for addition and withdrawal within the batches of 10,000 USD and its multiples or whatever is the amount. So there's no generalized answer to that. It depends on the fund. But many of the funds have got a withdrawal mechanism, which is in the multiples of 10,000 or 20,000 USD.
Right. Thank you so much, Daxesh Bhai and Rajit, for sharing such a valuable insights with us this evening. Your clear guidance on Indian inheritance and retirement planning certainly would help our NRI community here in Australia and understand the importance of planning early, structuring it wisely, and ensuring the peace of mind for the future. On behalf of everyone present, I sincerely appreciate the time and expertise that you've shared with us tonight. A big thank you also to each and every one of you who've joined us for this webinar, and we know your time is valuable, and we hope you found this session both informative and practical for your own financial journey. Those who would like to take the next step, Ashutosh Financial Services is here to support you personally with tailored advice and solutions. We encourage you to reach out directly for a one-on-one consultation or further guidance on your financial needs. And with that, we come to a close of tonight's webinar. Thanks again to our esteemed speakers, to Ashutosh Financial Services, the team, to all of you for being part of this important conversation. Have a wonderful evening ahead, and we look forward to seeing you at our future sessions. Stay safe and financially empowered. Good night, everyone.
And thank you, everybody, for allocating time on a precious weekend. And special thanks to Sanjay for hosting this event. Thank you so much. Thanks to everybody.
Thank you.
Thank you, everyone.
Thank you.